So you're all set for retirement and you have a solid plan in place to get you comfortably through your golden years. Did you know that far too many Americans fall victim to running out of money due to overlooking the constantly rising costs of healthcare and retirement? Lucky for you, I'm about to detail how to ensure that you can cap your healthcare costs to avoid being a burden on your kids or running out of money. Do you want to cap those healthcare costs? Then let's talk about what long-term care insurance is, as you may not be familiar with it. There are things known as activities of daily living. These include getting out of bed, getting out of a chair, getting dressed, going to the bathroom, taking a shower, eating, putting your clothes on, being able to brush your teeth, walking, climbing the stairs, things like that. Around 75% of Americans will need some sort of long-term care assistance or help with aging. What do I mean by this? As people age, there's a point where they can't do activities of daily living on their own and they need some help. And the help ain't cheap. It can be really expensive. Let me tell you the average cost. So a nursing home can be about $8,000 a month, which is $96,000 a year. And what if you wanted to have a private room? Now the cost increases to $9,000 a month, which is $108,000 a year. That's a lot of money. The average stay in a home is around 3 years, bringing the cost of getting long-term care to over $300,000, and that's in today's dollars. What if we factor in inflation? Right now, the cost of aging is growing faster than the inflation rate. For the average 60-year-old, if your total cost is $325,000 in today's dollars, with inflation at 4%, by the time you get to age 80, the real cost can be $700,000, and that's enough to derail your financial plan. In a perfect world, you'd purchase long-term care insurance when you're in your 50s, when it's much cheaper. As we know, the world is not perfect. In fact, most people start thinking about it when it's too late, when their body is telling them to think about it. Do this before it's too late. In fact, Dave Ramsey recommends you do this at age 60. A relationship with a financial planner goes so far beyond investments and money. It's personal, it's comprehensive, and it will give you a sense of financial security. Far beyond dollars and cents. So let me give you my 2 cents on the topic by showing you how I helped a couple of Seaside clients fit long-term care insurance into their retirement plan. If you're 55 and over and you're worried about the cost of aging, then keep watching, as just one major medical event can blow up a lifetime of retirement savings. Remember, there's a 75% chance that you're going to step on this landmine. Are you feeling lucky? If you are, you might as well go to Vegas and put your money on black, because at least then your odds are 50%. But if not, let's dive in. Let me introduce Hank and Roxanne Johnson, who are in a good financial situation. Hank is 62 years old and getting ready to retire from Amazon. Roxanne is 60 and a vice principal at a private school. They're both looking to retire soon, and we're working on a retirement income plan, which is in pretty good shape. Hank and Roxanne's priorities are to ensure that they do not run out of money in retirement. They also want to make sure that they're not a burden to the kids. They like to leave the kids a little something at the end of their lives. They want to save up a nest egg that's enough to be able to live freely in retirement. Hank and Roxanne are on track to retire next year at age 63 and 61 respectively. Even with the conservative growth rates that we use in our plans, we're projecting retirement with a total liquid asset sum of over $1.6 million. It's all good, right? But before we pop the champagne and high five and hug, we took them to the Decision Center to test their plan against 1,000 randomly generated scenarios, looking at different market conditions. After stress testing their plan, their base case had a 99% probability of success, which is a solid A in my book. With our confidence zone going down as low as 82%, 99 is rock solid. So let's take a look at their plan, and you'll see that here they are heading into retirement, and they're in great shape. So their retirement assets continue to grow, and here they are all the way out to age 100 with over $2.6 million left at the end of their life. They're in great shape. Now we know that markets never give us a straight linear return, so we always stress test our work. And what we found was the probability of them not running out of money was very strong at 99%. So they're in a wonderful position right here to weather the storm. But the one thing that their plan failed to take into consideration is what happens if there's a major medical event in the future. In other words, what if they do need assistance with aging and that cost is now in their plan? And so we ran a scenario where Hank was age 80 and had 3 years in an assisted living facility right around $10,000 a month, so $120,000 a year. We took that expense at today's dollars and we inflated that at 4%. And what you see is when that expense shows up in their plan, it ends up costing them over $2.2 million because the money that has to get spent on the assisted living facility goes away, and then the opportunity cost, the money that's not growing for them any longer, loses the compounding effect. So it's really a double whammy for Hank and Roxanne. And what's worse, when we stress test this, now their probability of success is terrible. It's 69%. They're clearly out of the confidence zone. It gets worse. When Roxanne, if she were to have a healthcare event as well, now their probability of success drops to below 50%. So in other words, there's a good likelihood that they're probably going to run out of money should one or both of them have some sort of major medical event. And remember, the odds of one person needing care, 75%. So what can they do about this? I talked to them about traditional long-term care insurance, which kicks in if you cannot do 2 of the activities of daily living. A long-term care insurance policy will start to pay a daily benefit. They can have cost of living adjustments on there to help keep up with the rising cost of healthcare. And there's traditional long-term care insurance, and there's also hybrid long-term care insurance, which typically is tied into a life insurance policy or an annuity. There's pros and cons of both. One of the things about the hybrid policy that people like is that there's a death benefit attached. So if you're one of the lucky 25% who doesn't need care, the long-term care policy tied to the insurance contract will actually reimburse your survivor should you not need to use the policy in your lifetime. So again, pros and cons to both concepts. The important thing is that you understand what's out there, you have a financial plan, and you try to fit long-term care into some aspect of your financial plan. So for Hank and Roxanne, they went ahead, they really liked the hybrid policies that are out there. And so let me show you what happens if both of them need assistance with long-term care and they purchased a hybrid policy. Take a look at how the story changed. Now, by having the long-term care insurance, the probability of not running out of money was back to 100%. So they got to realize their primary objective, their goal of not running out of money in retirement, of not being a burden to the kids, and because they had this plan in place, they were also able to leave a little something to the kids after they passed away. Folks, you just saw the numbers. The cost of not having long-term care insurance isn't just about money. There's a cost of your emotions as you watch your hard-earned money vanish, or the shame you may feel as you have to rely on your children to care for you as you age. As a financial advisor, I've seen far too many people have their savings completely wiped out due to just one major medical cost. No one thinks it'll happen to them. But let me remind you that 75% of all Americans will need long-term care. Do you gamble on asking your kids to move back in with them? I don't think so. Let's face it, when it comes to retirement, people put more thought into when they're going to take their Social Security benefit rather than the medical costs that'll make that benefit irrelevant. If you'd like to discuss how to fit this 75% chance cost into your retirement plan, please get in touch with our office to book a free call and discuss it. You can also like this video, subscribe to the channel, and keep watching to learn how to become a smart retiree.